Okay, so we are in this week we are doing chapter 9. So it's about net present value calculation and also other investment criteria. So the first question I'm going through here is ABC Incorporation is looking at investing in a 3-year project that will create cash inflows of 7,500 in the first year, 8,500 in the second year, and 9,500 in the third year. The cost of this project is $20,000, okay? And the required return is 12%. What is the net present value of this project? So again, the first thing I always do is I'm going to draw a timeline, okay? So now and then there are 3 years potential future cash flows. And then I will label the cash flow, right? So the cost of this project, that is the upfront money you had to pay, right? So that's the $20,000, which is the cash outflow. So that's defined as a negative number. And then after you have this investment, you expect to receive future positive cash flows from the project, right? So you're going to have some cash inflows in the future, as indicated, 75, 85, 95, 100 for each of the following 3 years. Okay, so now the question, and you understand that the required return is 12%, and you want to know what is the net present value of this project. So let's take a look at the first approach. We are using formula. Okay, we are using formula. So the idea is that this negative $20,000, this is a present value because it's now, right? It is now. So this negative 20,000, it is negative 20,000. But this green values, this is the future incoming cash flows. So these ones has to be discounted using the required rate, 12%. So the question now comes to the point that what are the present value of the future cash flows, these 3 cash flows, right? So this one is not that hard. We can calculate the present value. I use the green color representing the future cash flows, right? Not the upfront investment. So the year 1, that's discounted by, divided by 1.12. Year 2, divided by 1.12 to the power 2. And year 3, divided by 1.12 to the power of 3, right? So after doing these discounting factors, I'm able to calculate that the present value of all these future cash flows is actually $20,234.49. Okay, so this is the present value of what I can get, right, from the future inflow. But upfront, I'm having a $20,000 outflow. So what is the net present value, right? So the in minus the out, right? So the in, the present value of the future inflow, that's the green color, and the one out is the green. So basically, I have a net present value of $234.49, and this is greater than 0. So we should take this project. Okay, we should take this project. Does this make sense? Give me a thumb up, please, if you understand this. Okay, good. Okay, so this will be the formula approach. If you want to do it mathematically, you want to do a calculation based on by hand, right? Using calculator. We also can do this using a financial calculator. Given there are only 3 cash flows, it's manageable. We can enter this information to a financial calculator. Okay, so how are we going to do that? So you first press the button on your calculator, CF, that's representing cash flow, right? You press the cash flow, and then the first one would be CF0. CF0 is the initial, right? The initial cash flow, which is a negative number, negative 20,000. And then the next one is CF1, 7,500. And then the question is how many 7,500 in the streams? There's only one 7,500. So F01 equals 1. So this F01 representing the number of the CF1. Okay, so there's only one 7,500. So F01 is 1. CF2, that for the second year is 8,500. And the F02 representing how many 8,500 in the stream, and there's only one. CF3, that would be the third year, so that's the 9,500. Again, F03 is 1 because they are all the one unique cash flow amount. And then you press NPV, you enter 12% for I, you compute NPV, and you will get this result, $234.49, which is exactly the same amount as we calculated using formulas. Okay. Keaton, are you familiar with this financial calculator? Is this something too strange to you? Are you familiar with this? Okay, good. Okay, next method, we can also use Excel to calculate net present value. Okay, so the way you set it up is that you labeled year 0, year 1, year 2, year 3, and you entered the relevant cash flows for each corresponding years, right? Now, the formula for calculating net present value is this. So NPV, that's a short form of net present value, and then bracket, and the first parameter is the rate, which is the required return. So in this case, so that should be 0.12. So you have to enter this in decimals, okay? So in this case, the rate is 0.12 because the required return is 12%. And then value one is the cash flow for the year 1. Value 2, that's for the cash flow for year 2. And value 3 is the cash flow for the year 3. And then closing bracket. Okay, so far you are calculating the present value of this future sequence, right? And net present value, you have to consider the value 0, which is the initial investment. Okay. So once I'm doing this, okay, you can see my formula here equals NPV bracket 0.12 B4 to D4. So this is my B4 7,500 and BCD. So this year 1 is the column B and the year 3 is the column D. So I have B4 dash D4. So that means I'm collecting the range from B4 to D4, BCD, okay? And then I add A4. This is A column, so that representing the initial investment. So maybe I should make this clear by adding more information. So now maybe it's a little bit confusing here. I'm gonna put here column A. This is a column A. Okay, and column B, C, D, B, C, D. Okay, and this is the row 4. Okay, so I have to also get some more information here. This is row 4. Okay, so this probably will make things a little bit easier. So I'm going to use this purple Okay. Does this make sense? So if you use Excel, you can just calculate this way. Again, you can see that I get the same result. So the same question, you have three alternative ways to do the calculation. Okay. So are you okay with question one? Can we move on? Okay, awesome. Okay, so now let's do question two. Okay, question two is about AAR, which is average accounting return. So this question, calculate AAR given the following information: revenues, cost of goods sold, admin expense, interest expense, tax expense, and also the average book value of the investment. So how AAR is calculated? So AAR is calculated by your net income divided by your average book value. And the average book value is pretty obvious here. So that is the $80,000. That's the $80,000. Okay. And the net income, right? You have taken some of the financial accountings, right? So you have revenue minus cost of goods sold. So that gives you the gross profit. And then you minus the expenses, including admin, interest, and tax. So you figured out your net income is actually $12,048. Okay. And then you're following the formula net income divided by book value. So you get 15.06%. Okay. So this is a very easy formula. So the division between two numbers, numerator is the net income. The denominator is the average book value here, which is even given. So in this question, you are actually only calculating the net income, and then you get the result. Okay. Are you okay with this? Okay, good. Question three. Okay. So question three is about IRR. Okay, IRR. So what is the IRR? I representing internal, right? The first R representing rate. The second R representing return. So IRR is the internal rate of return. Okay. So in this question, they want you to determine the IRR of a $400,000 project promising annual cash flow of 120,000 over 5 years. Okay. So if you think about it, right, each year you receive cash $120,000, right? If you don't consider the time value for 5 years, right, the amount of cash you received will be 120 times 5. So you received $600,000, right? So you invested $400,000. In return, you get $600,000, right? So you know that, right? There is the return, right? There is the return. But the question is, how much? Is that 10%, 20%, 30%, right? How can we know what is the return, right? The rate of the return for this project, right? So that's the question. So again, for IRR, this rate will make net present value to be 0. Okay, so what is the rate of the internal rate of return? This internal rate of return is the rate at which that the project has a net present value of 0. Okay. Hey, Godfrey, it's good. You come. So Keaton, it has a company now. So does this make sense? So internal rate of return is the rate at which that the net present value of the project is equals to 0. Yeah, no problem, Godfrey. I'm glad you made it. And so now again, let's draw this picture, right? Draw this picture. Okay, I only have 4 years or 5 years. I only have 4 years probably. Okay. So basically, we are saying, well, the green color cash inflows, if that present value of all these green cash inflows equals $400,000, okay, which is the initial investment, so then my net present value will be zero, right? So basically, we are saying that the present value of the future cash flows is actually equal to your initial investment, right? So to achieve that present value, right, we can work backward to figure out what is the return. That would be the IRR, right? Does this make sense conceptually? Do you really understand what's the internal rate of return? Okay, good. Okay, so now for this, I have two approach. Okay, I have two ways to deal with this. The first one, I can use calculator. Okay, if you take a look, this are the equal amount for 4 years, right? So this is the ordinary annuity, right? And you know the present value, right? The present value should be equal to $400,000, which is the initial investment. And you know the payment, right? The payment is 120,000. And you know the n equals 4. Sorry, there's a typo. This question should be, just give me a second. This is 4 years life, not 5 years. Okay, so my n equals 4. And the future value, right? There's no lump sum payment in the future. So future value is 0. So then I price compute I/y. So that gives me 7.71%. Okay. So what is the net present? What is the internal rate of what is the internal rate of return? That is the rate that your future cash flows, the present value of your future cash flow, at that rate is going to equal to your initial investment. Okay. So and then this question becomes of like you know the present value, okay, you know the payment, you know n, and you know future value, and then you just calculate the interest rate of return. Does this make sense? Okay, good, awesome. You guys are awesome. Well, the next approach will be using Excel. We use the goal-seek analysis. I'm not sure how what is the sophisticated level of your Excel skills, right? In my previous videos, I have shown students how to do a goal-seek analysis, which is a very useful tool. Okay, many people don't even know it, including people who have used Excels for a long time. So I just want to show you to see how helpful this is, right? To that, I'm going to show you my Excel file. Okay. Can you see my Excel? I'll make this bigger. View 400. Oops. Selection. Okay. Are you able to see? Okay. Yeah. So I have just shown you how to use net present value to calculate how to calculate net present value using the Excel sheet, right? So because two students just joined in, I have to repeat myself on this. So how can you calculate net present value using Excel? So you set up like this, right? You have year 0, 1, 2, 3, 4, right? And then year 1, year 0, that would be your initial investment cost. So that's the negative. I use a minus number. This due to this is a cash outflow, right? You have to pay this minus $400,000. And with that, you expect to receive 120,000 for 4 years, right? So year 1, year 2, year 3, year 4, each year 120,000. Okay, and we want to know, right, the rate, the discount rate, and we want the net present value to be 0, right? Because if net present value is 0, right, the rate that makes net present value to be 0 is the internal rate of return, IRR, right? So in this case, you can take a look. The formula for net present value is NPV, and then rate, right? That's the discount rate. And then you have to go from the first year, okay? This is really important. Don't go with year 0, okay? In the bracket, you have to start with the year 1, okay? And year 2, year 3, year 4, okay? And then you add, okay, and the closing bracket, and then you add the initial investment. So that's your net present value. So in this case, let's take a look, because I build this into the formula, right? This is my formula following this rate. So if my rate is 10%, my net present value is negative or close to negative 20,000, right? So we are looking for a rate that makes the net present value to be 0, right? So if you go, well, what about 12%? Well, 12% make it even worse. So they leads into an even greater negative number, right? So we know that is less than 0.1. What about the 0.6? Oops. Oh, sorry, 0.06, 6%. If it's 0.06, okay, and then I have a positive number, right? So it has to be between 6% and 10%. So then you can do this approach called trial and error, right? So you try it and then see what's the net present value until you fine tuning it down to the point NPV is very close to 0. But this is very time consuming, right? So this cell, net present value, is linked to this cell through a formula, okay? The formula is like this, okay? The first parameter of the net present value is rate. That's why these two cells are linked. So now I can use the goal-seek analysis. My goal is to seek this cell to be 0, and then I want to change this cell. So by changing this cell, I want to reach a goal for this cell to be 0, okay? So now let's do, go here, data, and the type data, and then you move this way. There is a what if analysis here on the top. What if analysis, then you click, go seek, okay? And then which is the cell you want to set it up? Well, the cell is this cell, right? B9, that is net present value cell. And then you want it to be what? Which number you want this cell to be? Can anyone tell me? What's your goal on this cell? What do you hope this cell to be? Nobody? This is the net present value, right? So what do you want this net present value to be? Let's see. Did anyone say anything? Oh, 0. Yes, very good. So you set this up to be 0, and then you want to change which cell. Okay, I want to change the rate, right? I want to change the rate. So I set it up. And now don't blink, okay? Don't blink. The magic things is going to happen, okay? Are you ready for this? This is like a magic, right? You ready? Okay, so if I click OK, what is going to happen, right? If I click OK, see? So the computer will calculate it, the rate, right? They will be really smart, right? They will figure it out. When the rate is 0.0077, this number, your net present value will be 0, right? So this rate is the internal rate of return, the IRR, right? And this is exactly how we got what we got from using the financial calculator, 7.71%. Okay? Do you find this tool analysis is pretty cool? Do you like it? Do you like this tool? Thank you, Kaden. Have you ever used this one before? Yes, but I prefer calculator. Yes. Yeah, I totally understand. Yeah. Sometimes if you build up, if you link two cells, right, you can do something that are very interesting, right? For example, you know all the grades, right, from the different component of a course, right? The only thing you don't know is the grade for final exam, right? But you know you have a desired total grade. Let's say you say I'm an A student. I'm hoping that overall my grade is 90. I can get an A, right? But there's only one thing in the final exam, that's uncertainty. So then you will be say, I set up my goal for the total score is 90. What do I need to achieve for the final exam in order to reach that goal, right? So basically, in that kind of scenarios, you can use this goal seek analysis, right? So they will work backward for you to tell you, oh, you actually only need like you did really well, right? For all the other component, you only need like 50% of in the final exams to get overall 90%, right? So those are the things that you would find useful. May not necessarily always in the finance context, right? In your life, right? Sometimes it's nice to have this tool. Okay. Does anyone have any question here? So give me a sum up if you understand this. Okay, awesome. Thank you. So I'm gonna close this one. Okay, so you can see that using calculator is 7.71%. So we get the same when we use Excel. Okay. The reason why I'm giving you all these different alternatives is that, first of all, when you know different ways to do it, when you have enough time, you can cross-check it, right? So you do it in one way, and then if you have time, maybe it's worthy for you to check if your result is correct and doing it another way, okay? Second of all is that you may find this really useful in the workplace, right? You are start using Excel, right? You would find that it's much easier to use Excel than financial calculator, right? So because it's all built in, right? You could build in a massive template, right? Lots of calculations, they are linked together, right? Instead of you know, pressing the buttons all the time, right? So you define the benefit of using Excel in the future when you start working, right? So I think it's a good idea to get to learn how to use the software. Okay. So now let's move on to the last question. Okay, the last question. Okay, so question 4. This company is purchasing new equipment at a cost of $325,000. The equipment will yield incremental cash flows of $100,000 in the first year of its operation. After that, the incremental cash flows will decrease at a rate of 10% per year. The equipment is expected to last for 6 years and will be worthless at the end of its life. What is the net present value of the equipment given the required rate of return, 15%? Okay, so again, let's draw a timeline. In this case, the equipment is expected to last for 6 years. So I labeled 6 time intervals on the timeline. And then the value, the initial cost, the out-of-pocket cash flow is 325,000. So that's a negative number. And each year you're going to get some cash flows. But the funny part is these cash flows are not constant, right? They are not annuity, right? When you talk about the ordinary annuity, the condition would be that the payment amount, the cash flow payment amount is always the same, right? But in this case, that in this model, the payment amount is decreasing at a constant rate, 10%, right? So for example, the first year is 100,000, and the second year it decreased by 10%. So you calculate 100,000 times 0.9, and the third year will be a further 10% decrease. So now you multiply it by 0.9 to the power 2, and the year after power 3, power 4, power 5, right, at the year 6. So the cash flow is decreasing over time, which is reasonable because the equipment is getting old, right? The ability to earn money is decreasing, right? So yeah. So this is kind of the situation, right? And they ask you to calculate net present value. So basically, you want to figure out what is the present value of the green colored cash flows, right? Once you figure out the green present value, you minus 325,000. That is your net present value. Okay. Well, the most straightforward way to do this is, well, you would say, well, it would be really good if this is annuity, right? So if it's just $100,000, and then I can use a formula, right? Can anyone tell me what is the formula for the ordinary annuity? Who remember the formula for the ordinary annuity? Anyone? What is the formula for ordinary annuity? Okay, let's see. Denti said PVC times. Oh yeah, you're absolutely correct. Yeah, that is the formula, okay, for ordinary annuity, right? So let's see here. So if you take a look at the left side of the screen, so that's where my cursor is circling here. Did you see the ordinary annuity? the PV equals C times, and that is the division, okay? On top is 1 minus 1 over 1 plus R to the power of N. That's the number of the cash flow divided by R, which I rewrite it differently. Okay, you see the purpose. So basically 1 plus R minus 1. So the two ones will cancel out. So you still only have 1 R in the denominator. Okay. Normally we don't do this, right? It's just ridiculous, right? But there's a reason why I write this way. I'm gonna explain to you more shortly. Okay. So, anyways, the ordinary annuity, the present value is C, right? Multiplied by this factor, right? Okay. So in this case, it's not an annuity because the payment is not constant. It's decreasing, but the model is interesting because it's decreasing at a constant rate, right? Decreasing at a 10% rate per year. Okay, for that, okay, I'm gonna tell you this formula can be modified. Okay, so how? So it modified like this. It used to be 100%, right? Every year is the same, right? So it's 100. The next year is 100% of the year before, right? Because they're the same. So that's the one. But in this model, the next year is only 90% of the first year's cash, right? So that's 0.9. So I'm gonna replace these two ones using 0.9, okay? Using 0.9. Yeah, so that's the formula, okay? That's the formula for this kind of model, okay? So if you do the calculation, you would notice that that present value is actually $308,097.36. So in this case, we have C equals 100,000 and N equals 6. R equals 0.15. So if you bring all those numbers into this formula, you should get 308,097 and dollars and 36 cents. So that's the present value of the future cash flows, right? So that's kind of your gain, right? What is your loss, right? What is your cost? Your cost is your initial investment, 325,000. So why take the difference between the green number and the red number? I realized that the net present value is actually just a negative close to 17,000. Okay. So if you are, if you have to maintain a 15% return, obviously this project is a failure, right? Because this project will not promise you a 15%, maybe only like 14%, 13%, 12%. You have to calculate the IRR, right? IRR. Okay, does this make sense? I know this formula may be quite new, but this is the best way I can explain to you. In my previous videos, I show you how to develop this formula. It's not that hard, honestly. I have shown you all the groundwork, okay? Why the present value, the ordinary annuity, by the formula is like this, right? So the reason why I know all this formula really well, because I can derive it by myself, right? So I know where each number coming from, right? So that's why I'm presenting this modified version of the ordinary annuity. Okay, so it's important you memorize that one. Okay, does anyone have any questions on this question? If you're happy, give me a thumb up, please, so that I can be happy too. Okay, yeah. Yeah, so that's all I can offer. These questions are picked from the assignment. So when you do the assignment, you will see similar questions. So watching these videos definitely will help you to do the assignment, okay? Not all the assignment. So, some of that, right? So, okay, anybody have any questions? Okay, so that's what I can offer tonight. Nobody sent me email asking me any questions, so I assume that's a sign of people doing well. No question. Okay, and so I pull out 4 type of important questions from the assignment, so that I can help you a little bit with the assignment, and also these are the really important things I want you to know. Okay, so the Connect assignment contains MRR questions. So if that happened, I'm gonna write it off. So basically, I will give you a credit for that. So I don't care your answer, right or wrong, you get the full mark, okay? So that was a mistake on my side. Yeah, the MIR questions should not be there. Okay, Keaton? Yeah, thanks for letting me know, okay? Okay, anybody else have a question? I'm gonna pause the video.